All right, so a very warm welcome to today's, well, this evening's webinar. Look, we're a little bit early, so I'm going to give the attendees a little more, a couple of seconds to enter the room, and then we'll get this going. All right, so look, my name's Aaron Hill, and I am the Chief Market Analyst here at FP Markets. Today's presentation is based on volatility, as you can see on the main slide here, and essentially how to trade volatility. Um, Look, first and foremost, thank you for taking the time out of your day or evening to be here. I do hope this is a useful presentation. There should be no issues with sound or visuals, but if you're experiencing anything, please do let me know in the chat box and I'll see what I can do. Those who are unable to watch the entire presentation or just want to watch the presentation again, there will be a recording available through the usual avenues. So our YouTube channel under FP Markets or under the resources tab on the main website. Now, as for the questions, if there are any questions during the presentation, it's fine to send them across in the chat box. If they relate to the slides that I'm currently presenting. However, we will be holding a brief Q&A session at the end of the presentation. Now, as usual, guys, I do have to show this disclaimer. The information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. But guys, I'm not going to read all of this. Suffice it to say, this presentation is not investment advice. It is simply an educational presentation. Okay, so the topics for this webinar, I'm going to try and keep this as structured as I possibly can. So we're going to learn about first and foremost, we are going to learn about what volatility is, and then we're going to look at the different volatility measures that we can use in the financial markets. Interpret key volatility indicators such as the VIX, Bollinger Bands, and average true range. I do use all three of these volatility indicators, so I'm quite familiar with their dynamics, if you will. And then we're going to understand some specific strategies that I do use, particularly with the VIX and Bollinger Bands, and how we can use average true range to set stop losses and things like that. And then we'll end with a live Q&A session. So if you have any questions at the end, do feel free to ask. We did have some attendees fire across some questions beforehand, actually. So I will go over them at the end. All right. So what is volatility? So volatility, or vol, as it's more commonly referred to, measures the magnitude of price moves of an asset, either up or down. Of course, the more dramatic the price swings in an instrument, the higher the level of volatility. Now, vol can be measured using historical price changes, which is commonly referred to as realized volatility. Now, this looks backward. It measures how an asset's price has actually moved in the past. Or it can be a measure of future volatility. So it represents the market's expectation of future volatility derived from options prices. Now, when options prices are high, implied volatility, or IV, suggests that bigger moves are expected. You often see this ahead of big events. So think of events such as the NFP, the non-farm payrolls event, or look at Nvidia's last earnings report. One day in the single day IV was a whopping 7% either way. This is insane. So the markets expected some very, very big moves, although we didn't get it. But the markets were expecting some big moves out of that event. Now, on the other hand, low implied vol suggests a limited price movement is expected. Now, why should you care about volatility? Three key reasons, of course: risk assessment, strategy selection, and position sizing. Now, risk assessment. If So high volatility, of course, equals higher risk, but on the other hand, it also equals potentially higher reward. Low volatility, on the other hand, suggests stability and limited profit potential. Now, strategy selection, which should be self-explanatory. So, different strategies, as I'm sure you're all aware, different strategies work in different vol environments. What works in a calm market may fail spectacularly in a volatile one. Position sizing. So, I thought I'd add this into here as well because, look, volatility directly impacts how much capital you should risk per trade. So more volatility requires, of course, smaller positions to maintain consistent risk. So the different volatility environments, of course, we have low, medium, and high vol environments. So low volatility, uh, during these environments, you will find that price moves slowly within tight, narrow ranges. Markets are calm; they're almost boring. You can think of this. I remember someone saying to me, "Think of it as a gently rolling sea." So price action is subdued, but here's where it can work. So we can use it for range trading. We can identify clear support and resistance levels in a market, and we can play the range edges. We can buy near support, sell near resistance, and we can use tight stops because volatility is low. It Some analysts believe that this has a higher win rate but smaller profits per trade. I'm not too sure on that, to be quite honest with you, because I'm more of a high vol trader. I prefer mean reversion plays, which I will get to shortly. But yeah, I can't validate, that it offers a higher win rate. That will be up to you to decide through your back testing and forward testing, of course. A low vol environment also provides time for breakout preparation. So what do I mean by that? Low volatility, of course, it doesn't last forever. For anyone that's aware of Bollinger Bands, the Bollinger Band squeeze, right? So when the markets start to exhibit narrow trading, you'll see those Bollinger Bands contract, and that usually precedes a breakout, either to the upside or downside. So we watch for volatility contraction patterns to form within low vol environments. And then we position for the eventual expansion with smaller starting positions. So in low vol trading environments, you're trading for small, consistent gains, I guess. You can think of singles and doubles rather than those home runs. Now, medium or normal environments, vol environments, this is where you'll find a lot of traders. This is where a lot of traders do target in terms of their strategy selection. So you can think of a very common way of trading trend following. I'm quite a big fan of trend following, especially in longer term. You have so you can look at moving average crossovers within normal vol environments. Breakout strategies are pretty successful as well. Momentum plays. Trailing stops work very well in the normal vol environments. You can also look at swing trading, um, which is a trading style that you hold trades for days to weeks at a time. So some technical analysts I've heard say that within a swing trading environment or a long-term trading environment, technical patterns are more reliable. I agree to some points because this is really when I first began when I first started trading on the technical side of things, I was really that was I heard that a lot, and I did believe that for a long time. But um, once you understand price action, once you understand that there are good setups on the lower time frames, I don't tend to follow that much anymore. So, look, a lot of traders do say in normal vol environments, the especially for swing trading, the technical patterns are more reliable. That would be up to you to back test, but for me personally, I don't tend to agree with that anymore. Look, another thing with swing trading, standard risk to reward ratios of 1 to 2, 1 to 3 are achievable, of course. But again, you can achieve that on the lower time frames if you know how to trade or to day trade, if you will. Um, and then you have the high vol environments, right? This is where for a long time, I really didn't. I really stayed away from this. I really, again, it was drummed into me from the very beginning of my career. Stay away because I was primarily a technical analyst, but I've merged into a combination of macro and tech now, where I need high vol to generate profitable trades. Um, so high vol is usually large, rapid movements. Markets can be quite jumpy and emotional. I think I remember reading that it is at this point where the markets jump and they look to find a new equilibrium because once new information hits, traders are looking to recalibrate their positions, right, to align with the new information. So high volatility is a completely different approach, in my opinion. We can look at things like mean reversion. I'm a big fan of mean reversion. Prices overextend frequently. Look for it. You can look for things like exhaustion patterns, fade extremes. Um, I do agree that you should use wider stops, especially if you're trading in high vol environments. Obviously, to accommodate the high volatility, the high price action uh, being more erratic than usual. But for high vol mean reversion trading, it's usually a quick in and out. You don't overstay on your position. You can also sell vol. You can sell volatility, but this is quite an advanced way of trading. So when implied vol is extremely elevated, you can sell a vol. You can sell options premium, credit spreads, for example. But this requires quite a lot of experience and is certainly not designed for beginners. Um, so do bear that in mind. So look, selling a credit spread for anyone that's unaware of what a credit spread is an options trading strategy where you simultaneously sell a higher premium option and buy a lower premium option of the same type and expiration, which results in a net credit to your account. Now, this strategy is used to generate income while limiting risk, and it it profits if the underlying asset stays above a certain price, that's a bullish outlook, or below a certain price, which is a bearish outlook at expiration. And yeah, so this is something you could potentially look at. In high vol environments as well, look, reduced position sizing. So this is something, this isn't really a strategy, but for many new traders, it's critical, right? But the more experienced you become, you understand these high vol environments very well, and you look to have a set of guidelines that. So, for instance, if A and B happens, you know you can risk 1%. But if A, B, C, D happens, you know you can risk 2%. If A, B, C, D, E, and F happens, you know you can risk 3%. So I don't really subscribe to reduced position sizing. I subscribe to a more careful, considered approach, depending on how the setup plays out. Again, I'm combining macro and technical analysis there. Wider stops in high vol environments, of course, I definitely agree to that. I do believe that you should have wider stops in high vol environments. But for me personally, look, I don't tend to jump into a market following news. I tend to wait between 2 to 5 minutes following the news event and then look to fade a breached resistance or a breached support as a trade. So I do tend to work with smaller stops than some of my colleagues do when they jump into a position. So it could be 40 or 50 pips for them, depending on the setup. So in high vol environments, capital preservation is certainly paramount, but that goes for um, normal vol as well and low vol, to be quite frank. Reduced exposure in high vol, I would agree with that to a certain extent, um, but you have to certainly be more selective. Now, I do apologize. I have to go to my, there we go. All right, so let's take a look at the tools we can use to help us measure these conditions, these volatility, right? So this is the VIX. This is a very famous volatility indicator, the VIX or volatility index. This is actually the futures price of the VIX and the one that I use the most. To be clear, I only use the VIX for one setup. Which I'll explain shortly when we arrive at the Bollinger Bands. It has an incredible win rate, and it's very, very easy to trade if you understand what you're looking at. It's all on a daily time frame as well, so this would suit many traders that have to work full time or have family obligations and things like that. So as for the calculations of the VIX, the formulas behind its value, this is rather complex and certainly beyond the scope of this webinar. And look, to be completely frank, it's also beyond my mathematical abilities. And you know something? Despite what you may have been told, you do not need to be a mathematician to trade the market successfully. In fact, all the genuinely successful traders that I know, um, none of them claim to be good at maths, which is it's quite ironic, but none of them claim to be good at maths. They've just spent the time understanding the markets and understanding their strategies. Now, the VIX was introduced in I think it was the late 1990s, or the early 1990s, excuse me. And the calculation is actually based on options pricing of the S&P 500 index. And it essentially measures the IV, the implied volatility of S&P 500 options over the next 30 days. This always confuses me because the VIX is actually an annualized number. I'll go over that shortly. It's often called the fear gauge as well, because you'll see it spikes higher when investors are worried and they tend to buy more protective puts. This is an option strategy, if you will. So I won't go into detail about calls and puts here, but look, suffice it to say, what I mean by protective buying a protective put in S&P 500 derivatives is you are essentially hedging away your long exposure in US equities, assuming you hold a long position in US equities. Buying puts essentially means you've taken a short position in the S&P 500 through a derivative product. So that could be futures or options. Really, as well, something I should add is you cannot trade the VIX directly, but you can trade it as a derivative. As you can see on the screen here, this is the futures, as I said, futures product, and you can also trade it through options as well. Look, with futures and options, you can either speculate or hedge against potential changes in market volatility. Um, Look, both are cash settled. VIX futures and VIX options are cash settled, meaning that there is no physical delivery of the underlying asset, of course. And that's really all I have to add regarding this. Now, this is where I will begin showing how I trade, but I really need to get this across. So, look, when there are when there are no other factors at work here, in most cases, a high VIX reading. Look, you can apply it as well. Something I do use often is I apply traditional resistance and support areas to 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 derive an overbought and oversold to derive overbought and oversold conditions within the on the VIX. So I knew once price hit this level, I knew we were considered quite overbought or quite overstretched to the upside in terms of volatility. So historically, I'm just trying to line this up nicely. There we go. So historically, the pattern in this relationship between the S&P 500 and the VIX has been one of an inverse correlation. So when the VIX spikes higher, as you can see, the S&P 500 trades lower. Conversely, when the S&P 500 rallies, the VIX tends to sell off or decrease. And this is very common behavior of the stock market. It has repeated itself in bull and bear cycles. Um, So what is hedging? What is hedging? Well, you can see here the S&P, as I've said, the S&P 500 and the VIX futures product, they both move inversely. This is because when stocks rally, so stock, just like now, really, the stock market is rallying. There's less fear. There's markets are more complacent, so there's no need to buy. There's no need to go into the options market and buy protective puts. Hence, implied volatility drops. Um, and once you see implied volatility increase when a the stock market is exhibiting a downturn, this means traders are entering the market and buying protective puts to protect on the downside. I mean, I think this was around a 10% or a 20% move. So what you'll see is investors going into the options markets and buying protective puts, protecting against that downside without really liquidating their long exposure. So you're just buying protection, really. Think of it as insurance. Traders can also buy VIX derivatives to protect their portfolio from losses. So if the S&P 500 falls, you can actually just buy the VIX. Um, we know during a downturn the VIX tends to rise, so you can just buy VIX derivatives to protect your portfolio from losses during a market downturn. You can also use derivatives to bet on whether the market volatility will increase or decrease. Think of this as buying the euro dollar, or buying the euro against the US dollar and things like that. For example, if you expect volatility to spike higher, you might buy call options call options or futures on the VIX. This is akin to trading the index, as I said, the VIX index through derivatives. Again, you can't trade the index directly though, guys. So one thing to remember when you're trading, when with hedging, you're essentially transferring risk, but with speculation, you're essentially taking on or assuming risk. One important point I do really want to reiterate here is that the VIX is an annualized value. So the number you see here is the expected annual volatility. Therefore, the S&P 500 in this case is expected, let's just round that off to 20, is expected to move 20% over the next year, either to the upside or to the downside, based on one standard deviation, which is around 68.2%. So an annualized one standard deviation move. Look, I know, guys, I know this can be confusing. Let me try to clear things up and go back to the slides here. Bear with me, guys. Okay, so look, standard deviation. I will try not to spend a long time on this, but I do think it's worth spending some time to understand this. So here you have what's referred to as a standard bell curve. This is, of course, not an accurate representation of price action, as prices are not normally distributed. What do I mean by that? Well, I'm sure you're well aware the financial markets can be quite an unpredictable beast. We have fatter tails, which is than a normal distribution. So we have tails that extend out to the negative, and we have tails that extend out to the positive. This is because extreme events happen more frequently than predicted in the financial markets. And this pushes volatility out past two standard deviations, sometimes even three standard deviations. And so this is why you will never really see prices as reflected as a normal distribution or a standard bell curve here. Look, you can think about it as the market's tendency to overreact or underreact to news, and this can influence prices beyond three standard deviations. So look, 68.2%, this is one standard deviation. Two standard deviations is around 95%. And look, let's round this up, 100%. Three standard deviations is where you'll see 100% of the data. So approximately 68%, this is one standard deviation, guys. The data, so approximately 68% of the time, the data falls within one standard deviation. of the mean. So this is the mu. I think that's how you pronounce. Or I do apologize if I've got that wrong. It's a long time since I studied statistics. Mu, or the mean. So it's 34.1% below the mean and 34.1% above the mean. So this range here includes the most frequent occurrences or typical outcomes in a data set. Two standard deviations. This is around 95%, as you can see here. The data, so 95% of the time, data falls within two standard deviations. This broader range is often used in statistics to define a significant result as values that extend outside of two standard deviations are considered less common. Now, approximately 99.7 or yeah, 99.7 of the percent of the data falls within three standard deviations of the mean value. Data points outside of this, so 0.3%, guys, are considered extremely rare outliers, and or exceptional events. Now, that's all well and good, but how do we? So we have the annualized number from the VIX. Remember on the VIX, I won't go to the chart right now, but we have the annualized number from the VIX of 20%, right? So how do we get monthly, weekly, and single day volatility? Because that's what we want to know, right? We want to know what are the markets expecting for 1 day vol. So remember what I said at the beginning, Nvidia. Markets were expecting a whopping 7% in either direction for Nvidia ahead of their earnings last week. So how do we calculate single day volatility? Single day looks at the expected price movement in a single day, according to the options market. So let's assume there are 252 days. That's what I always use. 252 trading days in the year. So we first have to take the square root of 252, which is 15.87. Look, guys, to make it easier, just remember these numbers. Note these down, these square roots, so you don't have to keep calculating it if you manually calculate your IV. And then we divide the annualized value, which is 20, by the square root of 252, which is 15.87. And that gives you a 1.26% single day IV. So based on an annualized value of the VIX at 20% or 20, we have an expected single day IV of 1.26% either to the upside or to the downside. Determining weekly IV, it's the same process, guys. The only thing that really changes is the square root. So we look at 52 weeks in the year. So 50 square root of 52 is 7.21. And then dividing this number by the annualized value of the VIX gives us 2.77%. So again, once we do that, we have a 2.7%, 2.8%, let's say rounded up, weekly IV either to the upside or to the downside. So this is very good. So we know 2.7% either to the upside or to the downside. If we're taking a position that could last 3 or 4 days, we know that the markets are expecting a possible move to the upside or to the downside of around, so say 3%. Let's round that up, 3%. So we can place our stops just beyond there. And we can also use that for profit taking as well. We know the market based on one standard deviation is unlikely to exceed this value. Then we look at monthly IV. Again, square root of 12, so that's 12 months to a year, 3.46. We divide the annualized rate by 3.46, and this gives us an annualized rate of around 5.8, sorry, a monthly IV rate of around 5.8%. So we know based on this what the market is expecting over the next 30 days. So if you're a medium-term swing trader, this could be something to take into account. Now, I will spin back to the charts as I want to go over the next indicator, which is something I'm sure you're all aware of, is the Bollinger Bands. Now, the Bollinger Bands were created by a gentleman who goes by the name of John Bollinger. I believe this was in the early 1980s. The indicator's primary function, of course, is to help evaluate volatility and price action. And it really, this is how I see this indicator. It helps answer a simple question. Is the price of your chosen asset, chosen market trading high or low relative to its average price? Now, the average price in this case is the 20-day simple moving average. We're on a daily time frame here, guys. So it's a 20-day SMA. But if you're on the 4-hour chart, this will be the 20 period SMA. Uh, Look, the Bollinger Bands, we did do quite an in-depth webinar on this some time ago. So do look for this if you're interested in learning more about the Bollinger Bands. But the Bollinger Bands also um, use work based on standard deviations. And it's constructed through three bands. We have the upper Bollinger Band, we have the middle, and the lower. Um, and this is always applied over a securities price action. The indicator is made up of, as I've said, a default 20 period or a 20-day SMA and two outer bands. The upper one is set to two standard deviations above the mean and two standard deviations below the mean value. Um, so if you remember that bell curve, if we're taking a market that we assume is normally distributed, which we know it's not, this would mean 95% of the time price is contained within these bands. Now, I did quite a lot of research on the Bollinger Bands, and John Bollinger himself, through his own testing, said that it's around 90% of the time. So it's a 90% confidence band because, again, prices are not normally distributed. The key logic really here with this indicator is that when price action surpasses the upper or lower band, surpasses two standard deviations, there is a chance of either the market breaking out to the upside or downside, depending on which way we break, or reverting to the mean. This could mean price recoils back to the 20-day SMA. Or to the lower Bollinger Band. Um, Look, one of the great things about the Bollinger Bands, I won't go into too much more detail regarding this, but it can be used on all time frames. It can be used across all different major asset classes, so FX, indices, shares, commodities, you name it, digital currencies or crypto, as you can see here. And as I said, it can be used across different trading styles. So if you're a scalper, you can use it. Swing trader, you can use it. A longer term trader, you can use it. Now, I did mention at the beginning of this presentation that I do use it particularly for one setup on the with the VIX and the S&P 500, and it has served very, very well. And I actually learned this method. I'm not sure if any of you are aware, but if you're a budding technical analyst and you're interested in furthering your understanding, the CMT course is quite an in-depth course, Chartered Market Technicians course. Um, I'm in no way affiliated with the CMT, but I am a CMT, so I do vouch for their teaching there. Um, and I learned this on the course there. So, look, as we know, I have the VIX in the lower panel and the S&P 500 in the upper panel. Now, for anyone that's followed, I won't go into detail, but there's a harmonic. So let's just remove this just to avoid confusion. So let's just imagine there's a support here. There is a support. It's a harmonic support at 6,600 rounded. Now, I did note this in one of our chart of the days, I think. I certainly noted this to clients anyway. So we had an AB equals CD support at around 6,600. But what made this setup really, really interesting was, do you remember the S&P 500 and the VIX is inversely correlated, right? So when we have the VIX breaking out closing above that two standard deviation. This is these are the Bollinger Bands applied over the VIX futures product. So when you have the VIX breaking out to the upside, this tells me that we could be looking at a reversion back. Uh, Sorry, the VIX reverting back to the mean, and that's exactly what we had here. So that you see close to the upside, and this deep move into this AB equals CD. So I knew that the S&P 500 was in an uptrend. I knew that we were at support, a good harmonic trading support, and I knew the VIX broke out to the upside. Now, with this, I noted that we could be in for a mean reversion play. As you can see, we have seen price rally to the upside on the S&P 500, and equally, we've seen the VIX pull back, and we are now at the 20-day SMA. But for anyone that does follow harmonics, if you look at what's happened, if we take the traditional profit objectives, I'm willing to bet we are now at trade completion. This is where traders tend to reduce risk to break even at this point here. Um, and take final profits at around the 61.8% Fibonacci retracement value of legs A to D. So we are now at the final take profit value according to that structure, alongside the VIX hitting the 20 period simple moving average on the Bollinger Bands. Now let's just look at this in another light. So if we look at this area here, I mean, look, this is not a guarantee, right? But you need to use your due diligence. And look, it's another, look at this move. Look, this is something I didn't really see, but I know that the Bollinger Band, I mean, look at that. 1 second. Let me pull this up. This is what's called an alternate. This is another AB equals CD pattern. I remember looking at this back in when it was occurring, actually. So we have at the same point, look at this, we have the VIX, sorry, we have the S&P 500 on the upper chart testing that alternate AB equals CD pattern of support between the 1.618% and the 1.272% Fibonacci projection ratios. At the same time, we have the VIX really pushing to the upside beyond that Bollinger Band. Now, look, if we go to do you remember three standard deviations? 99.7% of the time that we have price. I mean, look at that. We are now just beyond, I think it's just beyond the three standard. This is an incredible move. So volatility is really extended to the upside here. And in addition to this, remember, we have that resistance area on the VIX. So there's so much confluence in this trade here that a reversal to the upside in the S&P 500 would have played out. Of course, you do get some false starts with the this setup, but this is where your technical expertise does come into play, and you only trade at decent, clear support levels. You don't just trade because the VIX has pushed above that upper Bollinger Band or anything like that. You have to wait for technical confluence here. So this is something I watch very closely and something that played out beautifully as of late as well. I swear it was the chart of the day I highlighted this at, or I think it was in one of the reports. I think it was in one of the first light news reports we did recently, because it was just an ideal setup for a pullback into support and a rally to the upside. So with the Bollinger Band, now forget the VIX for now. This is just one setup I do look at when I combine volatility measures. This is brilliant because it combines the VIX and the Bollinger Bands and the S&P 500, of course. But if you just trade the Bollinger Bands, now there are a number of ways you can trade the Bollinger Bands. Over time, I've found my own little ways. I've done considerable testing on this. This is the BTC USD, the Bitcoin versus US dollar on the daily chart. Now, how you trade this I would never trade the Bollinger Bands in isolation. What I mean by that is I would not just sell because prices hit the upper boundary. I would not buy because it's just hit the lower boundary. That's a sure way to, I believe, account ruin, which is where you run out of money or you just have to throw in the towel because you can't take the losses anymore. One very easy, I say very easy, trading's not easy, but very straightforward method of trading the Bollinger Bands is to combine the Bollinger Bands with the RSI indicator and look for clear-cut oversold levels with divergence, with positive divergence, and overbought levels with negative divergence. So as you can see here, look, the guys, full transparency, these are cherry picked. This was nothing I traded personally or anything like that. These are cherry picked. So we have what's known as a complex positive divergence here. So on the RSI, but we do have it where it's extending beyond the two standard deviations, and we could be in for a pullback. At the same time, the RSI is trending to the upside. So we have positive divergence there. Same up here. Price. Look, with the RSI, guys, just for some clarity here, you only look at the closing prices, guys. If you look at how the RSI is calculated, it focuses on closing prices, not the extremes. I see some traders basing their divergences on the extremes when it shouldn't be. It's on the closing prices. All right, so we have a negative divergence here on the RSI and price springing to the upside above that upper Bollinger Band, and we could be looking at a reversion play to the downside. Very simple. We can also look to combine support and resistance. Now, for anyone that's followed my work for a number of years, will note that I look for support and resistance to convert. I look for I have two key ways of looking at support and resistance. I look at the IQMs. I've done a number of webinars on Quasimodo resistances and supports. Do check that out if you're interested. But I look for the IQMs and supports, which is here. And I also look for yearly, quarterly, monthly, yearly, quarterly, and monthly opening levels. You'll be surprised how how amazing they are at holding price. It's truly an amazing and objective way of trading support and resistance. So this is how I looked at the Bollinger Band. Keep it nice and simple, guys. But yes, as I said, primarily I use Bollinger Bands for the VIX setup that I showed you here. Finally, we're going to look at the ATR. I saw someone put their hand up there. I do apologize if I've missed anything, but if you have a question, yeah, please do ask away. No problem. So the next chart, and this is the final chart of the evening, guys, we have the ATR. Now, I do use the ATR every now and again, but I'm more of a fan of the VIX and the Bollinger Bands. Now, the ATR, yeah, as you can see here, this is the Euro Dollar daily chart. The ATR is the average true range. It is a popular, it's a quite a popular and widely used technical analysis indicator, and it tracks the volatility of a particular market. Now, it was invented, I think, in 1980 or 1975 by J. Wells Wilder, I believe. And look, if you look into this, Wilder actually is the founder of a number of technical indicators, including the RSI, and also the average directional index, I believe, and the parabolic SAR as well. So, look, unlike other numerous technical indicators, the ATR does not, despite what you see here, the ATR does not indicate the market's price trend. It measures only the degree of its volatility. Now, interestingly, the ATR was initially designed only for the commodities market, but over the years it's been applied to all kinds of all different markets, including FX, indices, and things like that. Just bear with me, guys. Okay, all right. So, look, I'm not going to go into the calculation behind the ATR. It's pretty simple if you're interested. It involves calculating the true range, and then you have to do the ATR calculation. As I said, it's pretty straightforward, and there's a lot of information online regarding that. Again, guys, the ATR is not a directional indicator like the ADX, which is a trend-based indicator. It does not provide direction. It's just a measure of vol. However, I do need to note that the ATR is a lagging indicator. It does not directly project future price movements. So what it is traders use this use the historical data it provides to make decisions about current future risk management, I guess you could say. So for the ATR, primarily what I use it for is position sizing. So look, the ATR currently right now, I do apologize why this is not showing. Bear with me, guys. I do apologize for this. It should be showing the value. Okay, it's not showing. One second. So as you can see on the right axis, we have 57 pips. So the ATR based on a 14-day, I think it's 14 days is set to, yes, 14 based on a 14-day default period. The ATR is saying we have a 57 pips. So we know when we calculate our position size, we should really account for that. Um, I tend to, if I use the ATR to for my stop loss placement, I tend to look at 1.5 times the ATR. I know a lot of traders look for 2 times ATR, but for me, it really is quite excessive. I mean, look, in times of high vol environments, um, you could look at double the 2 times the current ATR value from your entry price, but again, I tend to look for just 1.5 times the ATR. Identifying breakouts. Look, periods of low ATR consolidation, if you will, are often followed by a spike higher in volatility. So a sudden increase in the ATR value can help confirm the strength of a breakout. Again, I don't really use that, but it is certainly something to keep an eye on. So yes, the ATR, I don't use this directly to trade. It's more for position sizing, profit targets as well. So we know 57 pips is the ATR value for the euro dollar on the daily time frame right now. I know if we exceed that, we could be in for if we reach 57 pips. So right now we're at 61 pips. If you look to the upside here, we're up 0.5% and we're up 61 pips. So we are now at the ATR value, and we could be in for a potential pullback. So it could be time to reduce risk to break even, or if you've got a long position on, or take some profit off the table. All right, so bear with me. Okay, hi. I do see your question. Look, we have there is a recording of this presentation on. There will be a recording of this presentation on the FP Markets YouTube channel. We also have, if you look on the main website of FP Markets under the resources tab, we have all of our archived webinars there, and you can access them there. So, in regards to this presentation, this will be, I assume this will be live tomorrow. I hope that answers your question. Right, so I am going to spin things back to there we go, to the end of this. Yes, no worries. Glad I can help. Patson, I do apologize. I'm not sure. I don't see a question there. Um, yeah, I do apologize. I don't really see anything I can answer there. Look, as I said at the beginning, I did have some questions fire through before the presentation. I'm not sure if any of those attendees are present, but they asked me something I did answer in the presentation, whether they can trade volatility directly. You can trade volatility, but it's through derivatives, so VIX futures, VIX options. You can also trade volatility ETFs. However, as I've said, these are quite complex instruments. So I'm just checking my notes. We also have a question: how often should I check volatility indicators? Um, this is down to you guys. This is really something you need to, if you incorporate it into your trading strategy, you should know that before you go live. For swing traders, generally daily checks are sufficient. For day traders, monitoring the ATR levels and intraday volatility for each session is certainly something to consider. Um, what indicator? I knew I was going to get this question. I knew I'd get this fired through. What indicator is the most important? Again, for me, the VIX is very, very important for that setup between where I combine VIX, Bollinger Bands, and the S&P 500 the VIX is incredibly important, but so is so are Bollinger Bands. So for me, it's the Bollinger Bands and VIX. But I know traders that favor the ATR. So it's all down to your personal preferences and the way you trade and the way you handle risk. We also had a question, how can I practice this without using or losing money? The question was, look, paper trading, guys. We offer demo accounts here at FP Markets. Open up a demo account and start trading and test your strategies out, back test them, forward test them, get the data behind you before going live. So that's all the questions I have. I'm just going to check if there's any more. All right, so no. Okay, so look, thank you all so much for joining today's webinar. I do hope I leave you with a clearer understanding of Vol and how you can adapt it within your uh, trading to different um, um, market conditions. Sorry, I'm just reading another question. Hi, Maria. What exactly are futures, options, and securities? Sorry. Yeah. So look, futures and options and securities. These are securities. That's not derivatives. They're more stocks and bonds, in my opinion. Futures and options are derivatives. And during the presentation, I did show that you can't trade the volatility indicators directly. You need to use derivatives. So CFDs, what you trade with FP markets are derivatives. They're based on the underlying asset's value. You don't trade the underlying asset. You're trading based on the value derived from the underlying assets price movement. If you're interested, Maria, we do have a number of webinars on futures and derivatives and things like that. So feel free to check them out. It would be quite a loaded answer if I was to go through it in detail. And yeah, so and I think personally the webinars will do a far better job of giving you a better explanation. Look, guys, one thing I do want to say is remember, volatility isn't your enemy. It's simply a condition to adapt to. The traders who succeed are those who recognize the current environment and adjust accordingly. All right, so if there are no other questions, I am checking the board here. That's pretty much all we've got time for today. Thanks once again for taking the time to join. I do really appreciate it. I hope you're able to walk away, as I said, slightly more informed than when you joined. We do have one more webinar for the year on the 16th of December. And this is where I go over what happened during 2025. It was certainly a year to remember, and what's next for markets in 2026. So that will be an interesting one because it's all about markets there. So with that, have a great day or evening, and I'll see you all again very, very soon. Thank you so much.